Within this bonus content, we will focus on an individual who has marked his time with his genius, Leonardo Fibonacci. Indeed, he introduced the world to mathematical concepts as varied as the Arabic numbering system, the concept of square roots, and of course, the number sequencing. It is therefore on this last subject that we are going to focus on, the sequencing of numbers from which the sequence of Fibonacci numbers and its retracement were derived. It is well after his death that we discovered that the structure of the sequence of Fibonacci numbers governs the elements that surround us. The ratio that defined the sequence of Fibonacci numbers was observed in the Parthenon, in the shells of mollusks, in human faces, and others. For the curious, and I recommend it to you, a video showing you the greatness of this concept is present within the notebook. The Fibonacci retracement are strongly used in the financial market almost 9 centuries after their creation. The Fibonacci retracement method is used to determine strategic position within consolidation phases or price impulses. It makes it possible to predict the amplitude of correction and rebounds in order to optimally take position within a trend, but also to target take profit and stop loss spot. In order to understand how retracements are created and how they work, let's first look at Fibonacci numbers. The sequence of numbers is very simple. It is calculated by adding the two numbers that precede them. Example, we are beginning with 1. Thus, 1 plus 1, 2. 2 plus 1, 3. 3 plus 2, 5. 5 plus 3, 8. 8 plus 5, 13, and others. The sequence of numbers is therefore 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on. This sequence has a particular properties. Each number is approximately equal to 1.618 times the previous numbers and 0.618 times the next numbers. As you may have recognized, 1.618 is the golden numbers, and 0.618 its inverse. It's called the golden ratio. In order to determine Fibonacci retracement, the golden ratio and its fraction can be used. Simply divide a number in the Fibonacci sequence by the next fixed number in the Fibonacci sequence. Let's take the number 144 as an example. 144 divided by 144 gives the retracement 100%. 89 divided by 144 gives the retracement 61.80%. 55 divided by 144 gives the retracement 38.20%. And 34 divided by 144 gives the retracement 23.60%. Similarly, this is the same method for the other numbers. Let's take an example with 21. But you have to introduce two spaces between 21 and the next fixed numbers. Thus, 21 divided by 55 is equal to 55 divided by 144. So the result is 38.20%. And you have to put 3 spaces for 13. So it's 13 divided by 55. So that is equal to 34 divided by 144. So 23.60%. We can see here that the 50% retracement is not calculated because 50% is not derived from the sequence of Fibonacci. Nevertheless, the level is generally incorporated because it is considered as a significant reversal level, recognized in particular in the Dow theory. Now that we have a better understanding of how reversal levels are calculated, the next step is to correctly incorporate them into the stock price. As a first step, we need to graphically identify the bottom and the top of the trend. Then, we score the rate from 0 to 100%. This is important to know that if the trend is bearish, the retracement line will rise from 0 to 100%. Inversely, if the trend is bullish, the retracement lines will move down from 0 to 100%. Horizontal lines are then drawn at the Fibonacci levels of 23.60%, 38.20%, 50%, 61.8%, and 78.60%. Let's take a look at a concrete example of the placement of the retracement level and their use. Here is the example from the Forex market, the foreign exchange market. In this case, we are looking at the rate of USD JPY, which is the US dollar against the Japanese yen. As you may remember, retracement levels are calculated when the market has made a particularly significant upward or downward movement and then begun a correction or trend change. First, we need to graphically locate the trend line bottoms and top. Then, we scale this weight from 0 to 100%. We have a first uptrend between August 7 and August 10, rather weak, not clearly defined, so there is no element that allows us to precisely identify a bottom as well as the top of the trend. However, between August 10 and August 12, we observed that the market made a particularly significant upward movement and then began a correction. Subsequently, this correction will lead to a change in trend. We can see it with this chart, so here is what happened afterward. I'm not a lucky person. What made me decide to choose this trend as the foundation for placing the retracement level is simply experience. The experience that you will get more or less quickly as you continue to learn and test your indicators. Let's start again. The trend is bullish, so the retracement lines will go down from 0 to 100%. Your platform, no matter which one you use, will directly trace the different level to their correct location. This is highlighted by the red areas. These lines represent the resistance and support levels where prices are likely to retrace. Once you have understood how the price reacts in relation to the retracement levels, you can use them from two different perspectives. In the first perspective, as part of a trend strategy, to take a low-risk position in order to take advantage of a potential profit zone before the price returns to the underlying trend. Within the second perspective, to get a guideline for the use of your take profit and stop loss orders. I will give you an example. If you decide to buy near to 23.60% retracement level with a take profit order placed around 0% and a stop loss order placed below the 38.20% level. Let's summarize what we have just seen in this graph. Retracement levels are calculated once the market has made a particularly significant upward or downward movement, and then has begun a correction, or a trend change. These lines, the Fibonacci retracement, represent the level of resistance and support where prices are likely to retrace. In this case, after an upward trend, the retracement level will allow to fix theoretical support within the following technical correction. The retracement levels are mainly used as part of trend strategy. One will expect a retracement within a trend according to different levels. Thus, we will try to take a low risk position in this trend in order to take advantage of this potential profit zone before the price returns to the underlying trend. Or you can choose to use the Fibonacci retracement to have target for the orders of take profit and stop loss. To finish, you have understood that the single use of Fibonacci retracement cannot be a trading technique, but it will help us to take a position and close the position at an opportune moment. Besides, it will also allow us to observe market behavior when the price reaches retracement levels.